Hello, and welcome to our next session of Reflections on Investing. And today I'm going to be talking about something that's, I think, of great current interest, and actually was the subject of my PhD dissertation many years ago. And that's the role of inflation and interest rates, both of which are likely to be affecting the market in the months ahead. And people tend to be confused about inflation. They think that inflation means all goods prices are rising. And to an extent, that's right, but it's a little misleading. It's not that somehow mysteriously everything is going up. Remember that all prices are measured in terms of the US dollar. So if the purchasing power of one good, the US dollar, is declining, that's going to be felt as all goods prices rising. Now, of course, all goods prices don't rise exactly together, because they're subject to the supply and the demand in individual markets. Like recently, lumber's been up because there's a lot of building activity. But overall, the decline in the purchasing power of the dollar will, everything else held the same, cause all prices to rise, and that's inflation. So let's go to the iPad, and here is our first exhibit. This actually graphs the purchasing power of a dollar from 1926 to 2021. And it starts with, in 1926, we say that dollar had $1 worth of purchasing power. And because prices fell during the Great Depression, the purchasing power of the dollar actually was rising. That's why prices were falling. And by 1933, a dollar would purchase what was now $1.40 worth of goods. But then a long period of decline in purchasing power, in other words, of inflation, has ensued since about 1933. And currently, as it shows on the chart, a dollar purchases 6.8 cents in comparison to $1 back in 1926. So we've had a long-term progressive decline in the purchasing power of the dollar, which we've experienced as inflation. And to get a better view of that inflation, move on to our next chart here. This is the annual inflation rate when it says rolling in the title there. What rolling means is you compute the inflation rate over the last 12 months. You go forward a month and then do it all again. And you can see that the inflation rate in the United States has varied quite a bit over time. This is the period of the Great Depression when prices were falling. That was the negative inflation or deflation. This is World War II, when due to the deficit spending, the expansion of the money supply, and restrictions on goods available, there was a lot of inflation. This is the great inflation of the late 1970s and early 80s, when inflation got up to nearly 15%. And currently, it's been running, as we see here, right around 2%. This red line is the 2% line. And that's pretty much been the Fed's target. But you can see that in the years since the great financial crisis, it's been below that target more than above it. Well, how does all this relate to interest rates? Here's the thing to keep in mind. If the purchasing power of the dollar is falling, if I lend you $10 and you pay me back 2 years from now $11, that 10% is paid in dollars that have a smaller purchasing power. So the higher the inflation rate, the more lenders are going to require in order to make a loan, because they have to not only get a rate of interest, they have to get compensation for the rate of inflation. And to see how all that works, let's look at the actual interest rates. Here's our next chart. It plots the interest rate on 10-year Treasury securities, and more recently, 10-year Treasury TIPS. TIPS means Treasury Inflation Protected Security. Here's how a TIP works. If you buy a TIP, over any year, you get a promised real rate of interest, that is adjusted for inflation, plus whatever the inflation was. So in effect, the government reimburses you for inflation, and then pays you a real rate of interest. The regular 10-year Treasury is just a standard nominal bond, it's called, because it pays off in nominal dollars, which are not adjusted for inflation, whereas the TIP effectively pays off in real dollars. So you can see what's happened. This plots it only from 1952 to 2021, but here is the great inflation. And when there was great inflation in the late 70s and early 80s, interest rates rose, and they went up to about 15%. Not surprising. Then there was a long decline, and currently the 10-year Treasury rate is under 2%, about equal to the rate of inflation. The TIPS are even more interesting. When the TIPS were first introduced here in the early years, they paid a real interest rate of about 2%. Means you got 2% plus reimbursement for inflation. Currently, the TIPS are yielding about minus 0.5%. So the government reimburses you for inflation, but above that, you've got to pay back about 0.5% to the government over the next 10 years. That's a pretty extraordinary situation, and it's one of the explanations for the current level of the stock market. So where do we think inflation is going? Well, let me have the market answer that for you. If I go back here, if we look at the 10-year interest rate not adjusted for inflation, and we subtract the 10-year interest rate adjusted for inflation, the difference is the expected inflation. So if you take the difference between the yield on TIPS, between the yield on Treasury bonds and the yield on TIPS, the difference is going to be a measure of expected inflation over the next 10 years. And here that is. And you can see that going into the great financial crisis, the market was expecting inflation of about 2.5%, a little more than the Fed's target. During the great financial crisis, there was fear of deflation, and expected inflation over the next 10 years fell almost to zero. Then during the COVID crisis, it also dropped all the way to 1%. But you can see in the last maybe 6 months or so, the expected rate of inflation has been rising very sharply. And this is what the market is worried about. Were this to continue, if inflation were to continue to rise, if expected inflation were to continue to rise, then interest rates would rise, and that could have a depressing effect on the market. It's been a lot to cover today. I hope you find it interesting, and I hope you pay close attention to both the Treasury yield, the TIPS yield, and data on inflation, because all of them are likely to have a significant impact on the investment markets. This has been Reflections on Investing. Thank you.